All right, everybody, welcome this evening to the industry webinar of Strata Ventures. And today we're going to be talking about private money lending for real estate investments. And we have a very special guest, Steve Ying of Easy Deal Properties. And he's going to be sharing with us his company information, private money lender's point of view, and most of all, some insight of what the private money lending arena is to real estate investors. And so I'm also going to be presenting before ahead of time just a little bit of data having to do with the private money lending world. And then at that point, we would move that over to Steve. So we're starting our presentation now. We're in the topic time frame right now. And then we'll go into Q&A around 7:10, 7:15, and see if we can make up some time. For those of you that are joining us via Zoom, you can go ahead and ask questions in the questions bar. There's no polls today. Moderator is Oriana. If you have any questions, please feel free to put any questions that are not topic related in the chat. Only topic related questions are in the Q&A section. And if you want to go ahead and leave the webinar, then it's in the hit the end button on your bottom right. And guys, remember this event is for you, so we encourage a lot of questions. This is the Strata Ventures team, guys. If you want to know more about them, feel free to scan the QR code down at the bottom right, and you'll be able to get more information about the Strata Ventures team. A little bit about myself. Some of you might know me, some of you may not know me. I've been investing in real estate since May of 2012. I was a prior mortgage broker and asset manager, and our company and platform has grown now in over 24 states virtually, because since COVID, now, Steve, we do everything online, which I believe was a sweet, sour type of scenario after the COVID scenario. So get to know us a little bit better. Company was established in May of 2012, and we are a full service real estate investment company that it has the 4 prongs of real estate, which is acquisition analysis, real estate services, project management and contracting, and funding. And we like to tell everybody the definition of what an investor does is an investor's identity is to analyze, act, invest, and make profits with one word in mind, and that word is risk. So with that said, we're going to go now into our topics here, guys. And we're going to talk real quick about the funding types, private lending, and security instruments. And then Steve, once I go through that, I'm going to go ahead and then stop my share and then go into your share, and you can go into your presentation. I'll try good as quick as possible to give you more time. But guys, this is more like a 30,000 foot degree view, because we want to invite everybody to come to get to know us. So Steve, this is you, married to Jean-Marie with 6 kids. I know every time I talk to you, you're either planning a giant family vacation somewhere or taking 1,000 people skiing, right? which is a fiasco. But I think you seem to be very good at it. You moved to Houston in 1981, attended Carnegie Mellon University. And then you also have a vast experience in construction lending. I'm sorry, in the construction industry, which, guys, for those of you that are going to be wanting to use services from Steve's company services, he does look at those deals with a fine tooth comb, because that's actually what a real lender should be doing, is identifying probably one of the most important parts of the transaction, which is the renovation and the construction. 36 years designing and selling lighting systems. And then you guys started flipping in 1990, and then you became a full real estate investor in 2020, which, congratulations. I believe from the times we've talked, you guys your business has exploded. And so we want to be able to showcase you guys here. So give me 1 second. All right. You were a member of SVI, and you're also licensed with TWFG Insurance, and you specialize in builder's risk and rental dwellings. Is there anything that you'd like to tell us from your identity here that you'd like to share?
No, you covered it pretty good. In fact, I was going to do the profile myself, but that'll get me through my slide really fast here when we get to it.
Okay, great. So let's start our topic, guys. One thing we like to tell people, especially with lending in the world of real estate investing, if you're new, you really got to know where the money's coming from. There's traditional bank lending, which obviously you can walk into a Wells Fargo, a Chase, and guys, they're not going to be what you call investor friendly to what we do, because they're more real estate loans for consumer retail structure. They're going to rely on personal credit, multi-trade lines, and basically what they call a full recourse type loan. And then your hard money loans are investor friendly loans and funded by funds of investors. Then you've got your private money lender loans, which are notes and profit share terms based on mutual terms and agreements. And that's where you come in, right, Steve? That's where you guys,
Yes.
on the private lending side, it's about the mutual terms, agreements, and basically building that relationship. And now there's something new called crowdfunding. There's a company that we are familiar with and started to use them. And they do now fractional type investments on a platform. And then they are funding an opportunity, and that opportunity obviously is collateralized by the asset. So there's now crowdfunding opportunities for real estate. But if I had to pick any of these here, my favorite is private money lending, guys, because you're building a solid relationship with your lender for longevity. Your hard money lenders, guys, real quick, is you got to think about your pre-approvals, such as your applications, your credit and cash reserves are what we call the three big ones. And then on your submissions for your hard money loans, make sure you have your items such as your contracts, appraisals, surveys, repair estimates, insurance, corporate entity documents, and proof of funds are basically some of the easy items that you can put together to obtain private lending. To hard money lending. And I'll get to you here in just a second, Mr. Steve, and we can get the ball rolling with you, is understanding the private loans and joint venture agreements. Is that you have your annualized rate terms, notes, monthly payments, and security documents. And then you also have your profit sharing or your entity formations, operating security documents, and literally no monthly payments. So there's many different ways of structuring this, but each PML is different. And lastly, what we have here are the security instruments that we primarily say you should always have available for any type of loan, especially if you're dealing with traditional, hard money, or private lending. The security is probably one of the most important things for a lender. It doesn't matter which one of those it is. You've got your deeds of trust, your promissory notes. Always they're looking for some type of a senior lien position, lien waivers for protection when it comes to contractors or liens that may be placed on the asset, and an insurance policy, loss payees to protect the investor, and most of all, also your operating agreements. So that was real quick there to buy us a little bit of time, Steve, because I know when you like to talk about private money lending, it's you know you're really good at it and you give a lot of detail. So I'm going to now stop my share, and I'm going to go ahead and move this over here to you. If you do not mind, go ahead and sharing your screen. I'd be happy to move that forward.
All right. Can you see it?
We could see it. Thumbs up.
Okay. I apologize. This isn't the format I normally do, but I'm just going to click these screens from the side here. Thanks for the great introduction, Diego. Topic here, of course, is private money lending for real estate. You did give me a real nice profile, so I won't really elaborate any further. I think you did a better job than I could probably do. So I do need this, before I begin, I need to go and show everybody this disclaimer. It basically says that I am not a licensed or certified lender. So if anything I tell you here today doesn't work out too good for you, please don't sue me. And with that said, let's talk about what you're going to learn here today. I need to begin by telling everybody that private money lending is a pretty vast, complex topic. So Diego said that he was giving you a 30,000 foot view. I'm going to make it now a 29,000 foot view. It's going to be basically geared toward beginners. I think that is everybody on this call is probably a real estate investor, prospective real estate investor. But there's a lot of diverse levels of experience. That's not to say here that if you're an experienced lender, you're not going to learn anything, but we just can't really with 30, 40 minutes get too deep into the weeds. This is probably a good time to mention that when I refer to the term real estate investor, that refers to both borrowers and lenders, and you're going to find out more on that. I'm going to give this presentation from both points of view. Of course, we're going to talk about the basics of private money lending, and another topic that is passionate with me is construction flow control. I think Diego mentioned that has been my background of almost 50 years, and you might not be familiar with that particular term, but you will be by the end of this presentation. Probably if there's one theme throughout that, if you want to remember anything, it is that you really need to understand what you're doing before you invest. So let's talk about what private money lending is. And I think the best example I always use to explain it is a mortgage on a house. I think everybody knows that process already. You've probably gone through that process or at least heard of it. The difference between private money lending and a regular conventional mortgage is it's not a bank. It's non-institutional. It's not a mortgage company. It's not a credit union. The other big difference is much higher interest rates, like double the rate. Another big difference is that it's much easier to get approved, and it has very friendly terms for investors. And what do I mean by friendly terms for investors? Well, biggest one is fast cash, quick approval in a few days, and getting your money quick. The reason we do this is, we're able to do this, is we got a whole lot less red tape and paperwork. Another big difference is that the loan is collateralized against the ugly house. You know, it's not the house all fixed up. It's a house in need of repair. It's also not amortized over 30 years. You know, we need the money for shorter terms, more like 6 to 12 months. And we want the payments to be as low as possible. And that usually means interest only with no prepayment penalties, meaning you can pay the loan off anytime you want as fast as you can. And basically, none of these things are what banks do. So if banks don't do it, who does? Well, the answer is hard money lenders and private money lenders. So usually when people ask me what private money lending is, and I tell them, they say, oh, like a hard money lender. Well, actually, that's because there's not much difference between a hard money lender and a private money lender as far as the basics, and that is we charge interest and points, and it's asset based. In fact, that's where it gets its name. It's a loan based off of a hard asset. There are some differences. Hard money lenders are companies like banks, but that have licenses to make loans. Another big, well, actually licenses in Texas are required if you charge interest more than 10%. Has anybody out there ever borrowed from a private hard money lender? You know if they charge more than 10%? Absolutely. Yep. Every hard money lender has a license. It gives them the ability to do a few things extra to make money, and that the main thing is arbitrage. They get a bunch of money from lots of other investors, pay them a lower interest, and then lend it out at a higher interest. That's what's called arbitrage. A private money lender, on the other hand, is actually an individual who has a private relationship with the borrower, sometimes actually referred to as relationship lending. When I say private relationship, I'm talking about your family, relatives, friends, acquaintances. Probably the largest group of people that you might do this with are other real estate investors that you meet at networking events. This type of lending does not require a license. It's much more loosely regulated. So let's get into borrowing as a private lender. Who are the prospective lenders that you should be looking at to do this? Well, it's definitely number one, it has to be people with money to lend. And it's generally people that want to make a higher return than what they're already making. Or they want to diversify, because most people with savings have their money tied some way, somehow to the stock market, and they want to diversify from there. A really good source of funds would be IRA money and 401ks. It's probably one of the best sources to use. And then as of recent, I think there's a big group of people that are pretty disgruntled with their 401ks or their savings because they're losing money now. Those people are the ones that are very likely to want to get into private money lending. I'm going to go ahead and divide those potential lenders into two main groups. I could call that knowledgeable lenders and unknowledgeable lenders. A knowledgeable lender is someone like a private money lending company, perhaps Easy Deal Properties, the company that we formed. Another one is other experienced real estate investors that are doing the same thing as you. But there's another group of people which I call unknowledgeable lenders. These are the people that are not in the real estate investing business. And there's a huge hurdle here for them. They need to be convinced that you're credible and you're profitable in your business. And they're going to have a whole bunch of objections. I have a list of them here on the side, and I'm not going to be able to have the time to be able to overcome all of these, but we're going to go ahead and try to hit some of them. So the first thing is, how does the business work, and telling someone how profitable it is. Well, it's pretty simple. We buy the ugly house, we rehab it, and we sell it at a higher price. It's not a new concept. Buy low, sell high, and we do that all using other people's money. I find that the easiest way to explain what we do is what I call the myth of HGTV. And the reason I call it a myth is I think that everybody that watches that network thinks that they can pick some nice colors and finishes and everybody makes money. Well, hopefully everybody does make money. So when you're approaching hit the wrong screen. So when you're approaching a potential lender, you're going to explain to them how they can share in these kind of profits, and you want to let them know how they're going to benefit. Well, obviously the high rates is the big intrigue, but on top of that, you let them know that you as a borrower are highly motivated to paying them. The reason for that is the way these deals work is you actually, as a borrower, get paid at the end when you sell the house. So you have a lot of incentive to get that house finished, pay the lender going forward. The other thing is you need to explain to everybody it's a very transparent and legitimate business. The transaction, the buying and the selling of the transaction are all done through title companies. There is no point during the process where the lender actually hands money over to the borrower. The bottom line is it's just another process of understanding before you invest. So there's a really important term here that if you've ever dealt with, I think anybody that's ever dealt with a wholesaler, I think they invented this term due diligence. And the reason I say they invented the term is you always see do your own due diligence. It's a way for a wholesaler to tell you, maybe I'm lying. All kidding aside, it's basically the core of what we're talking about here today. You need to really understand before you invest. I'm not going to get too into this because there's a whole course. Strata Ventures is one of the best ones, teaching you how to analyze these deals. I'll just go ahead and say that the core tool that everybody uses is the deal analyzer, which is actually a spreadsheet. There's a couple of real important numbers that I'll talk about here, and one is cost to value. And that is basically taking the whole cost of the deal, dividing it by the after repair value. And we have a target of 75%. You might have a different one, but that's pretty much the industry shoots for, somewhere around that CTV of 75%. Probably in the private money lending business, there's actually a more important number, and that is loan to value, LTV. That's the total loan amount divided by the after repair value, and we shoot for 70%. An important number to be able to make that calculation, of course, is the ARV. And I think probably the most important part of due diligence, and this is probably my construction background, but it's the walkthrough to determine the rehab estimate. I'm not expecting everybody to be an expert at this. I'll just tell you that if you are a member of Strata Ventures, there's an app that you just plug in like 53 questions into it, and it'll pop out with an answer. And of course, you can always validate with the contractor bid. I'll go ahead, and I'm not going to talk anymore about this other than I'm going to point out that when you're doing the repair estimate, there are 5 potential red flags that I like to mention to everybody. And those are foundation, roof, HVAC, electrical, and plumbing. And the reason I bring this up is aside from the standard stuff like painting and flooring, these 5 things could break you. If you make a mistake on any of these, it could cost you $5,000 to $10,000 each. Another really important part of due diligence is the title commitment. And I bring this up because whenever you go to title, you always get one of these. And I'm always just appalled by how a lot of the borrowers that we deal with have no clue what this is, sometimes don't even bother reading it. Just to let you know, it is a title commitment is what the title company gives you before they give you an insurance policy to assure you clear title. And it basically lists all the exceptions. And when I say exceptions, those are the things they're not going to cover you on in the insurance policy. I think the biggest complaint I hear is that it's a pretty daunting document with a lot of tedious reading and difficult terms. But I'm going to go ahead and give you a secret here how you read these things very easily. Remember, I told you it's a list of exceptions. Well, you don't have to read the whole thing. It lists all the exceptions, and they make it easy for you. They put all the exceptions in bold letters. So all you have to do is look for the bold type and read those exceptions. There's 4 parts to a title commitment, A, B, C, and D. You don't have to read it all. There's only exceptions in B and C. So real quick here, Schedule B, I like to say B stands for buyer beware. These are the exceptions that you can't do anything about. They're just telling you you're there. These you generally don't worry about, other than I put a red flag here on one, which is encroachments. That's when you have structures, your neighbor's structures are in your property or your structures are in their property. Those are usually costly things and hard things to fix. I will say that probably the best way to remedy Schedule B is to get a survey and buy survey deletion. Now, this word survey deletion, I hate it because I don't think it's very intuitive. Remember, I told you that this is a list of exceptions. So survey deletion means if you pay for this, you end up deleting the exceptions. And I'll just go ahead and say, if you buy survey deletion and the title company turns you down, you should probably walk away from the deal. Now, the second section to look at is Schedule C, and I say C stands for clear title. These are all the things the title company mentions that need to be cleared before they can close. I've listed some here. You might think these are just random things, but I'll just tell you right now, I just listed a few of the things that we encountered here. And I can say probably recently that have caused problems on a closing. Biggest problem is it'll delay it. I can tell you right now, it can delay it up to 6 months. Ask me how I know. And in a business of fast cash, 6 months will kill a deal. The other one I want to talk about is the red flag here of property tax foreclosures and redemption periods. I'm not going to tell you the whole process, but if someone doesn't pay their taxes and they lose your property and it goes to foreclosure and it's auctioned off and you buy it, there's going to be a redemption period. In Texas, it's up to 2 years. What that means is up to 2 years after someone buys that property, the person that lost it can go back, pay the taxes with some fees and get it back. So what does that mean? You buy a property that has one of these on here and you spend all the money to rehab it, and someone that lost the house drives by and say, wow, that looks beautiful. I think I'll take that back just by paying my taxes and a fee. You lose the property. So it's definitely a deal breaker. Bottom line, understand before you invest. I'm not going to go too deep into this. Diego already talked about the various required documents. I'm going to key on one here called the deed of trust, because this is the one thing that is probably different than a regular home mortgage. In a deed of trust, there's actually a third independent party called a trustee. It's basically a person that is impartial to either side, that's making sure the transaction is legitimate. And it's also very transparent, because this is the document that's recorded at the county clerk's office and made public to everybody. So, we want to make sure that all of our transactions are transparent and legitimate. This is the document that you do. Diego mentioned that we are also insurance agents. It was just a natural progression of what we do. This is an important component. Insurance policies are for the benefit, of course, of the borrower as the insured, but also for the lender as a loss payee. The type of insurance that you need to understand is depends on your exit strategy. If you're flipping, you need builder's risk and vacant dwelling and liability. By the way, builder's risk plus vacant dwelling equals ARV, or hopefully at least the loan value. If your exit strategy is for rental, you're going to want a dwelling fire policy. If you're going to rehab and then eventually rent, you're going to have to buy both of these. You're going to have to switch somewhere in the middle of the loan. And then, of course, I put another one on here, flood insurance for people that are here in Houston. This is pretty important that you check on the floodplain. If you're in the 100-year, you need to buy flood insurance on top of that. The last main set of documents is the construction escrow, and let's jump into that. I mentioned at the beginning of in my agenda that I was going to tell you about construction flow control. This is a term that probably comes from my construction engineering days. And basically what we're talking about is a payment plan for the construction. It's to control the flow of cash, and that is in the form of draws and milestones. We generally don't give you all the money up front and hope that everything works out. We want to make sure that it works out. Why do you need to do this? And I call these my golden rules of construction. Rule number one is it's going to cost more than you think. Number two, it's going to take longer than you think. And rule number three, stuff happens. So who is the one that does this? It's, construction escrow agent. And this is the part where you need to make sure you have a good construction professional that knows what they're doing, inspecting and evaluating the work on your job. And this is a huge benefit for both the lender and the buyer. Obviously for the lender, because he's protecting the money to make sure it doesn't run out before you get the job done, but also for the borrower, because think about it, if you have this extra set of eyes as a project manager looking over you and your contractor, it's a pretty comfortable feeling to know that somebody with experience is doing that for you. The last W is when. The important aspect here is draws are always paid after the completion of work. So how does construction escrows work? Well, the first thing you have to do is you need to know the exit strategy, and you have to determine a budget and make sure the amount of money that you have is feasible. Because once the loan starts, that escrow amount doesn't change anymore. The other thing you have to do is make sure that it fits into the time frame you're talking about, because you're paying interest the whole time as a borrower. It's the most expensive part of your carrying cost, and taking more time hurts you. The construction escrow is actually the same thing as the total repair dollars, and it's the amount of money that the construction escrow agent is paid and holds. It's actually paid directly by the title company at the time of purchase. I mentioned that the construction escrow agent works off of milestones. He'll create a milestone schedule with dollar amounts, and there are some other things that you have to deal with. But you can see the one that I highlighted the most, because this, I think, is the most important thing. It's called contingency. Contingency is things that happen that you didn't expect. It's that rule number 3, and it needs to be 10 or 15% of your construction escrow. You need to hold that and be ready to spend that, and it gets paid at the end. The construction escrow agent gets paid a fee. Normally it's a monthly fee. Sometimes it's paid in advance, sometimes it's paid every month. I'll just tell you that our company, Easy Deal, we charge $30 a month. That's about $1 a day. I'm going to go ahead and tell you $1 a day is the cheapest project manager you're ever going to get on a construction job. There are draw fees for $100 to $200. I call it that's every time you get a draw, you get that much deducted. We charge $100. I notice I didn't call it an inspection fee, and the reason for that is that we only charge it when we do a draw. I'll probably do inspections, every day or every other day. We don't always give a draw every time. I mentioned that I was also going to talk about the perspective of private money lender as a lender, because as many of you are real estate investors, you might want to become a lender yourself. And of course, if you're going to be wearing that hat on that side of the transaction, you're going to want to know the risks. Well, how is that secured? Well, you can look here on the left side. There's probably 3 big things that you have to be concerned about. That is the value of the house, the capabilities of the borrower, and catastrophe. And how you handle these risks, and this is probably Diego's favorite word of all time, is risk mitigation. I'm not going to go through all of these. We've actually touched on just about all of them. I'm just going to pull out 2 of them that you need to be aware of from the lender side. First one is the 30% safety cushion. And remember, I told you that loan to value is 70%. Well, that also means from the lender side, that's a safety factor of 30%. Pretty nice. The other one is skin in the game. It's right in the middle. If you haven't heard that term before, remember we loan 70% when the borrower's cost is 75%. Well, he does have some money in the game, but more importantly than that, that borrower has already spent a lot of time and effort acquiring that property, building that property. They've got a lot of what we call sweat equity. He's going to lose all that if he doesn't pay you. As I mentioned before, he's a very highly motivated borrower, and one of the main reasons because he has skin in the game. Uh, as a lender, you're probably the main decision you need to make is, and to go into private money lending is taking your money out of the stock market or comparing it to an investment in the stock market. So I'm just going to go really quickly here and compare them, but the benefits of private money lending, it is absolutely a very consistent high return. And then of course, there's that wonderful 30% cushion against falling prices. When you buy a stock, are you protected if the stock drops 30%? No. Do you get collateral? Do you get a house to back up that stock purchase? No. Do you get insurance where you are the lost payee if something goes wrong? No, never. How about a personal guarantee? Does the CEO of that company tell you he's going to pay you if his company doesn't perform? No, not at all. So there's a lot of benefits into diversifying into private money lending. I'm going to diverge a little here from the topic and give you a little history lesson. And I promise this is going to be very relevant, but there was two main events in history that happened. First one is the stock market crash in 1929. I don't think anybody on this call was around during that time, but that triggered the Great Depression. The other one was the subprime mortgage crisis of 2008. And that one, I think just about everybody on the call was around, and it caused a great recession. Because of those two big events, the world of lending changed. The federal government made some rules on what lenders could do, or more importantly, what they could not do. The main one from the 29 crash was the Securities Act in 1933, where basically said that you had to make full disclosure on all securities to prevent fraud. It's the butt of some old jokes about con men selling swampland or selling you a famous bridge in Brooklyn. But they did make rules on that, and they established a policing arm called the Security Exchange Commission, or the SEC. The SEC is very much still in existence and fully active. And it brings up the question here, is private money lending considered a security? So the answer is absolutely maybe. The good news is if you're talking about the plain vanilla loan that we've been talking about here with a private borrower and a lender and an ugly house as collateral, yes, it's totally fine. You can do that all day long. But where you start getting into a little more difficulty is if you make it a little more complex, perhaps a joint venture where you have an equity kicker and you're sharing in on the profits, or the crowdfunding avenue that Diego mentioned. Those are all a little more regulated. You have to be a little more careful to keep out of the crosshairs of these SEC laws. The second law that was a pretty big deal is Dodd-Frank. And Dodd-Frank is basically some laws for consumer protection, protecting you from practices on banks and insurance companies. And of course, the main one is mortgage reform. So they also established a policing arm called the Consumer Financial Protection Bureau. And again, the big question here is, are real estate investors considered consumers? And the answer, of course, is absolutely maybe again. I will say that if the borrower is a homeowner, they're definitely a consumer. You need to be careful on this. The best way to handle it is a profession that was created by Dodd-Frank is a registered mortgage loan originator, an RMLO. You need to hire an RMLO if you're going to be involved with lending to homeowners. And again, it's all about understanding before you invest. I do have one other law that you need to be aware of, and this is as a lender, it is called usury. Usury is charging a really high interest rate. It's absolutely a crime, going all the way to back to biblical times, but for modern day, It's essentially a maximum rate set by each state. Um, if you have seen a promissory note before, you've probably seen a usury clause in there where it mentions that if you're overcharged as a borrower, that any of the extra money above usury is reverted to principal. A lot of lenders tell me they consider this a get out of jail free card, but I've talked to plenty of real estate lawyers here in Texas, and they say that if you ever get a usury case, you just flat out go and try to void the promissory note by saying it's illegal. So in other words, the penalty is 100% you lose your money. So don't break the usury law in Texas. That rate, there's a judgment rate of 18%. You'll usually see these in your notes in the form of the wording of something like matured unpaid principals will be charged 18%. Again, it's just another way to understand before you invest. And that brings me to my last slide here. Appreciate Diego letting me speak here today. He said I could advertise my company. I don't know if that's really the purpose of what I'm doing here. I like talking about deals. Feel free to take my email and telephone number down and give me a call. I'd like to talk to you about your deals, spread my wisdom. And that concludes my presentation. Do we have any time left for questions, Diego?
Absolutely, Steve. Let me
Okay.
go ahead and I'm going to share your contact info right here, guys. So give me one quick second. Let me know if you guys can see. Let's see here. And let's see, Oriana, can you check and see, are we able to see Steve's contact information right there, if you don't mind? Double check. Yep, excellent. Thank you so much. If you guys want to get a hold of Steve, Easy Deal Properties, 281-433-4122, and it's steveying00@gmail.com. And Steve, one of the things that always resonates when I talk to you is you always touch on the things that will absolutely be catastrophic, right? In any, so I'll give you an example. When you were saying, and I feel exactly the same way, is it drives me a little bit insane on how many times people make a financial investment decision by walking a house 15 minutes and making an offer, but they just spent 5 hours buying a car. Makes sense?
I think that's part of the HGTV myth.
Yes, and it's that urgency, guys. It's why does there always have to be an urgency factor? There doesn't. You hold the pedal, you hold the brake, make sure you're aligning yourself with the right individuals in which you're buying, because if you buy it wrong, you're not going to survive to continue in this amazing industry. And Steve, would you agree? This is an amazing industry.
Yep. And I can't stress what you just said about that 15-minute thing, because I can tell you that there's actually real estate gurus that teach that concept. I myself have been in this industry for a long time, and I walk the house, I do the rehab estimate. I still do it the old-fashioned way with writing it down on a pad and putting it in a spreadsheet. It takes me a day to do that. It kind of kills me that you taught John Marie how to use the FastBid in that little device, and she does it, she does it 10 times faster than me now, even though she's never done it before. So,
but it gives her a great ballpark figure to come back to you and say, I think we're in the ballpark, and you're like, we're on the pitcher's mound, right? We haven't hit the home.
We love comparing results when we do that. We always do it together.
That's awesome. But it gives, obviously there's speed that is required because of saturation, but having tools and knowing the right people to get you as close as possible, guys, always refer to people, especially what Steve just said. He enjoys looking at deals, guys. Work with Steve, call him, give him, have him look at opportunities, but do your due diligence as much as you can ahead of time, guys, because he's a lender. He doesn't want to rely 100% on you guys saying, here, does this a good deal, right? It's no, what have you done? Show us the data, show us what tools you're using. And the other thing that I want to bring up is, you're right. You called them the 5 red flags. At SVI, we call them the 5 big ticket items. obviously the foundation, electrical, plumbing, roof, and HVAC. Those 5 things will eat your profit up in no time. And guess what, guys? Those are the 5 big ticket items you always see every morning while you're watching the news. Those are the companies giving people free estimates. Why not call them, right? Why not get at least that a point of guidance or direction on budgets from these companies that are giving you free estimates? So do that. Those things are vital. And last but not least, Steve, when you were talking about knowing and understanding what your relationship is and what direction to take, would you agree that your company and when it works with people, you're actually helping people scale, right? You're helping them
Oh,
scale their business.
yeah, absolutely. In fact, one of the things that um, I tell my investors, we do all the steps, we analyze it, and I usually tell them if we go through the process and we turn you down, we really hope that you don't do the deal yourself and go
Right.
somewhere else. And it's not because of competition or anything. We truly want you to be able to do it right so you can keep on doing this. We know you'll come back, whether we loan you to you or not, because we want to make sure all the deals are good.
And lenders talk. Some of the hard money lenders that we work with, they know each other. And sometimes a member will go to one and get a rejection, go to the next one, and then all of a sudden I get a call going, "Hey, you might want to talk to so and so. I think he's going off a cliff." And then the other hard money lender will call me, which is great. These are good lenders that are looking out for you because they want you to succeed. Because if not, you're not going to be a repeat customer, right? And you, Steve, I think you and Jean-Marie take it to a different level because you treat that as if that was a deal that you guys would be involved in. You really have to look at that. So here's Steve's contact information, everybody. And now let's get to some questions. Joseph Settle asked, do you offer long-term private lending money?
So if you asked me that question 6 months ago, we would have just said no. We typically help during the rehab process. We might go into a rental after that until you stabilize. But I can tell you right now that times are changing. One of the reasons that we don't do that is we typically lend at 10%, and those long-term ones, people were looking at 4 or 5%. We just really didn't want to do that with our money long-term. But now that those longer-term loans are more like 7 or 8%, I'll have to admit that we've taken a few. We typically will do something like a 15% amortization. Sometimes we even go interest only on that, but we'll put a balloon at 4 or 5 years with yearly extensions, just to try to carry people over in this tougher times. We can now tolerate doing 7 or 8%. It's better than 4 or 5%. And really the way we look at it is it's better to have a long-term deal at a lower interest rate without gaps in it. So the answer is we'll look at it.
Perfect. Let's see here. I would like to know what documents are needed if I'm a private money lender assisting other investors.
Okay. Well, that one's pretty simple because, the one part I didn't talk about is where we get money. I can tell you right now, we're a small company, but we've got, almost 30 active loans right now. Does that mean that I actually paid for 30 houses and rehabs? I looked in my wallet and didn't really have all that money. So sometimes we get money from other people. Who are those other people? They're the ones I put on the list. Just about everybody in my family now is a real estate investor. I've sucked up everybody's money. And so the reason I'm saying this is my job is then to be that assistant getting all those documents together. Remember I told you there's unknowledgeable and knowledgeable investors. Lots of the lenders, lots of people are unknowledgeable. And so give me a call. I that is our main function, to make sure all those documents are there. Assisting potential lenders with that is really our main business. I think Diego said, he said that we're a loan facilitating service, I believe you called us at one point.
Yes. And it's great because, you know, people come to us and they're like, hey, I'd like to become a PML. Can you show me what I did in this transaction? And instantly I'm looking at this and I'm going, where's the security? Well, you know, where are the, and they go, well, I really wasn't told I could do something, you know, have those kind of documents. And so you're really saving a lot of people there for what you and Jean-Marie.
And we do it over and over again. So we got some pretty good deals with attorneys, and you're going to save some money if you let us help you.
Somebody asked, what's the best way to group your draws while rehabbing?
Oh, one of my favorite topics here. So, you know, a lot of contractors are going to, usually you ask them for a draw schedule and they give you like, you know, a $50,000, you know, construction escrow, and they break it up into like 3 draws. Well, I'm going to tell you, I've been doing this for a long time. That is very unrealistic. It probably is to the detriment of the contractor, because remember, we pay when it's done. I can tell you, if you group a whole bunch of milestones together for a draw, that inevitably something on that list is not going to be finished and they're going to not get paid that entire draw. So what we do is I go down really deep into detail. A typical draw milestone schedule that I will produce is going to have, well, if it's a new construction, it could be hundreds of milestones, but it wouldn't be crazy for me to have 50 on a standard, you know, $30,000-$40,000 rehab. The reason I do that is I will go ahead and pay you a draw anytime you want on any of those things on the list. It's a much easier to achieve, and we don't group them together. The answer is you just get this big list of milestones with prices, and anything you accomplish, if you want to draw, go ahead and request it. It's going to cost you $100 if I do it, but you can get paid as often as you want. And I'm going to tell you, I actually don't even know how other companies do it. That's the only way we will do it.
Yeah, you guys doing it that way is the first company I've heard to do that, because most when we sit down for a project, we're going to look at what the lender considers a safe allocation of capital, and then how much money does the borrower have for the draws, and then the other one is how comfortable is that builder with having some money that they're floating themselves. So it becomes 3 different people's opinions of how that works, and trying
It's
to
the number one source of arguments. I'll tell
yeah,
you that
exactly
right now.
it is.
So I can tell you that the method I use is something from my nearly 50 years of being on the construction side of the business, and it is definitely to the benefit
Yes.
of the borrower and the contractor. But on top of it all, it makes the lender more secure too. So it's a win-win-win.
Let's see here. We asked, Ms. Deborah asked, do you pay the points to the private lender? Do you pair the borrowers with the private lender?
Yeah, great question. That's our business is a typical deal is 10% interest and 2 points. And the answer is yes, we do pair borrowers and lenders. When we have plenty of investors that come to us to borrow, that bring us deals. And if we don't have the money ourselves, we provide a lender. We create that relationship. And the way we pay is we give all the interest to the lender, and we keep the 2% for ourselves from making the deal. It's basically it's basically like the facilitator fee that Diego had mentioned earlier.
Do you lend in Florida?
Unfortunately, we do not. I get a lot of requests. My mother has been doing the business for 40 some years there. She would love me to start working with her over there. By the way, she's going to turn 90 in 2 months, and she's on her third flip this year. So,
All right.
so I have connections there. I have people that want me to do it, but we don't. Our license for insurance isn't good over there, and the laws are different. You
Yes.
mentioned that title commitment. I just had to help somebody with a deal. I had a hard time. I had to actually do a little training on how to, how to clear a title. So the answer is right now we don't, and I'll admit it's probably because I don't know enough to feel comfortable doing it.
Got it. So we have a question here. It says, I'm going to present to some friends to lend me money for a pad split or flip. What services do you provide that can complement my outreach?
So I think probably the best thing I can tell you right now is what I said at the end of my formal presentation is I love to talk about deals. I think you can give me a call. The fact that you mentioned a number of friends, I did tell you we did go into some of those federal laws. Pooling money is, if that's what you're thinking about, you need to be really careful. I think that's probably more than we can get into right now. I'll just go ahead and say, give me a call. There are some pitfalls that you need to be careful on if you're trying to do groups of people on that one.
Well, here's the last question, and it came through the chat, not through the Q&A, so I'm going to make sure I read this correctly. It says, if you said most PMLs are not all licensed, but that is usually required to be licensed to charge 10% or more interest, then how can you charge up to 11% interest plus points or fees of 2 to 5%?
Okay, I think I understand that question. I made the comment that in the state of Texas, you need a license to charge 10% or more. That was actually a sub requirement under hard money lenders. That is for companies that are hard money lenders. They have way more restrictions than private money lenders, and the reason is they're doing business with the mass audience out there. They are the ones that definitely have to be regulated because of disclosure and that type of things. Private money lenders are, remember, relationship lending. It's a person that has a private relationship with the borrower. So that's the big distinction. That license also gives you the ability to do that arbitrage method of generating income that I told you. Unlicensed people can't do that. Absolutely not without a license. So just make sure that you realize that that 10% rule is if you are a hard money lender as opposed to a private money lender.
Perfect. Steve, thank you so much. Everybody, Easy Deal Properties, Steve Ying, 281-433-4122, and Steve Ying 00@gmail.com. Thank you for your time this evening, Steve. We really appreciate that. We also want to go ahead and thank some of our company affiliates and partners that we work with. And if it wasn't for the relationships that we've built with people like Steve and some of the other larger companies, you get to pick and choose who you want to build a better relationship with, right? It could be the bigger companies, or it could be somebody like Steve, who I can guarantee you're going to have a great experience with them. So reach out to him, send him an email. Guys, the fact that he spent this time to give you an education piece, a bit of history, right, tells you that he wants you to become a better borrower. Wouldn't you agree, Steve? It's very important.
Absolutely.
Yep. If you guys want to know more about SBI and some of its great programs that we've got for your free one-on-ones, just go to investorrealestatetraining.com. And then also, if you wanted to get more information about us, past webinars, the girls here always ask me to tell you guys to like and subscribe. You can go to strataventures.com or email us at info@strataventures.com. or call us at 800-504-2909. And I need to give two very important bits of information. We have just launched our basics program. If you want to know more about it, give us a call. info@strataventures.com. Say, what is the basics program? We'd love to chat with you about that. And then also, we just started our live events at Quest IRA. Steve, you were there for the first one we did with our new partners at the Wealth Club. What did you think about that? Did you like it?
I really enjoyed it. I tell you what, I feel like it was a quick summary that I needed of everything that
Yeah.
you taught to me a few years ago. So it was a great refresher course for me.
Well, guess what? We're lined up for Houston. These are all live events once a month at the Quest office in Houston, Dallas, and I think we're getting on board with the Quest office in Austin. And these are literally, these live events are 100% to the realtor arena. So if you're a realtor and you're wanting to get yourself acclimated with real estate investing and knowing how to work with investors, now what does that do? It allows us to make a realtor a more knowledgeable instrument in this business, where now we can unify the realtor and the investor, and now this becomes not the wild, wild west. So with that, guys, it was great seeing everybody who joined us. Thank you so much on the participant list. Steve, you and Jean-Marie, you guys have a wonderful day. And are there any closing comments that you want to make?
No, I just want to thank you for giving me this opportunity to talk.
Anytime, mister.
We love Strataventures.
We love you guys too. Y'all have a wonderful day, everybody. Have a good evening.